Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 21st of July. I'm Daniel Lam, your host for the podcast. Earnings, tariffs, and data. These are the three key drivers that can determine the direction of risky assets over these few months. Now, as we spoke about in the podcast last Monday, the bar to beat is low in the current US earnings season. So far, the soft comments and the future guidance have been quite decent. Tariffs. Well, August 1st is the new focal point to be looking at, and volatility is likely to be persisting on tariff going into the beginning of August. That leaves data. So the US CPI figure last week was finally above expectations. That means now there will be extra scrutiny on the effect from tariffs. How has the data been since then? Well, the June retail sales beat across the board. It is very important to note that retail sales is not inflation adjusted and therefore is skewed towards goods, meaning some of the nominal gain may reflect tariff-driven price effects rather than accelerating demand. Now, adjusted for goods inflation, real retail sales growth remains positive but continues to slow. Meanwhile, the July Philly Fed beat expectations with broad improvement in activities, but low growth, inventory buildup, and margin pressure remains a risk out there. Firms continue to face high inventories alongside slowing sales. Inflationary pressures were mixed. Prices paid ticked up, but delivery times fell. Input costs are rising faster than prices received, putting pressure on profit margins. So yes, I would say that the effects of tariff-induced inflation is coming into the data. But inflation swaps suggest that investors still do not see much risk that inflation shocks, whether from tariffs or other sources, will become persistent. For the most part, markets are assuming that inflation shocks will not persist beyond a year, with price shocks seen essentially as one-off level shocks. However, there is small indication that investors may be seeing a little more risk of persistence since the beginning of July. So all these has implications for the Fed policy. The case for easing soon is much stronger if a tariff-induced increase in the price of imported goods seems acceptable, provided that the initial tariff-driven price level increase does not generate any second or third round price increases. And this is where the tussle is within the Fed. So one side arguing that the labor market is too weak for wage and price inflation to pick up in response to tariff-driven price level increases. Powell and the other more hawkish FOMC participants argue that the Fed should be waiting for the data to reveal if there's any follow-through. So the conclusion? Well, we're going to see plenty of volatility ahead in risky assets that can lead to consolidation there. So stay tuned closely to our podcasts and publications, and we'll be providing you with the latest thoughts and views on the markets.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.